Hi, I'm Toby.
And I'm Nick.
And welcome to the Pure Property Podcast with Track Capital, where we talk about all things property and property investment. The aim of the podcast is to give you bite-sized chunks of our industry insight and knowledge to help investors invest intelligently. And this week, we are going to be talking about loan notes, also known as property bonds or asset-backed loan notes. So this is a different type of property investing. And just before we start this episode, I just want to say, because we have to say this with regards to how loan notes are dealt with, that the information provided in this episode, it consists of generally accepted investment principles and a summary of the typical structure. There's nothing that we state here which should be considered financial advice or an opinion as to the suitability or unsuitability of any investment. So before deciding whether or not to invest in any financial product, listeners should either take professional advice from a regulated advisor or ensure they are able to make a fully informed decision themselves. So this podcast does not constitute as a financial promotion, and in general, loan notes are suitable for high net worth and sophisticated investments only as defined by the Financial Services and Markets Act 2000. Now that was a mouthful, had to be said, we can't be giving out financial advice. This is not something that we are experts on. We're not financial advisors, so that's why we had to clear that out. But obviously, that's probably scared a lot of people away, Nick. So why don't you let people know exactly what loan notes are?
Sure, yeah. We talk about scaring people away. We'll go into the pros and cons at the later in the episode. But yeah, so loan notes, it's probably a phrase that a lot of people have seen maybe advertised or heard people mention. So essentially what a loan note is a IOU. So it's a document, a piece of paper, ultimately recording a promise to repay a loan, usually with interest, based on specific terms. So if we look at that in the essence of the property market, it's essentially a document, or what some people refer to formally as a financial instrument, i.e. a contract or legal agreement, which details the specific terms of a loan agreement between a property investor, someone who's providing the capital and the finance, and then typically a home builder who's looking to raise capital to build out a development project. So that's typically how it's used for developers to raise capital from private investors. So you may have seen loan notes advertised offering, 10 to 15% returns per annum sometimes. And this is in return for security. So they might have a first charge over the property, a second charge, etc., etc. We won't go into too much detail now, but in essence, the summary is it's a legal agreement between a developer and a private investor where the developer is using the investor's capital to finance a construction project and they're paying the investor a fixed return back. It's as simple as that, really.
Yeah, and I know obviously we use the word developer there, but that can also be an agreement between, I suppose, somebody you know. You could have a friend that wants to build a house or has a project and they need some money. Rather than they go to the bank, they might ask you to loan them the money, and that essentially becomes an IOU, and you're going to charge them sort of interest, and that then becomes your return. So I suppose, is that a good way to explain it, Nick?
Yeah, definitely. It can be applied on a much, rather than the sort of professional, institutional level development, or not institutional, but sort of large scale residential projects can be used on a lower level. So as you mentioned, refurbs, conversions, joint venture projects. There's multiple ways you can apply it. But just a word of warning, if you are doing that, obviously make sure it's structured and you're going via solicitor to do it all properly. But yeah, you can certainly apply it on that basis as well.
Yes, I suppose that begs the next question: how do they work? So, in simple terms, a loan note it's an agreement between a borrower and a lender, and that will include all the associated loan details. So it will be considered a legally binding agreement. Hence, Nick mentioning before that you need to make sure the terms and conditions, if you are doing it even on a small scale, are ironed out, because you need that to be a legally binding agreement. And that's with both parties then considered committed to the terms that are written. So if the borrower is due to obviously pay back X to the person loaning the money, then that will be written down, and those terms and conditions need to be adhered to. So if anyone breaks that agreement, then there are legal implications involved. So in the context of the property market, loan notes are specifically drafted legal documents of which the investor will sign and agree to, and effectively lending money to a home builder or developer, whoever it may be, for a certain period of time for an agreed percentage interest rate. Loan notes are commonly used for raising funds for property development projects, large and small, and they are widely used across the UK. So that means developers have a lot more flexibility rather than just going to the bank, because you have to remember banks are very strict. They're very stringent tests and stress tests, and it's not the easiest to go to a bank and say loan me X for this project, because they're very fussy, especially with the last financial crash where they were lending out money and they've had to become a lot more stricter. So the loan note offers a solution for the developer in a way that it's say easier, but it's a lot more straightforward for them to get the funding a lot quicker as well. Because you have to remember, when they find these sites or if they find these deals, they do have to act fast, and sometimes having a bank involved can really slow down that process. So having that people invest via a loan note avenue makes it a lot quicker. There's less red tape, lower deposits required by the developer as well when sort of purchasing sites, and it's scalable, meaning that large levels of finance can be raised. So what you sometimes have there is developers, they'll have loan notes and the money sitting there already. They don't just find a site and then go out and raise it. They have the money sitting there, which means they can act fast, sometimes help them get better deals, better discounts, and ultimately, makes it a lot more straightforward and easier to scale when looking at different projects.
Yeah, exactly. I mean, that's when I used to work in a company and raising capital from investors. The first thing a lot of people would ask is, why don't they go to the bank, etc. So those couple of points that Toby just mentioned are really, really important, and they justify effectively why developers do it. The only bit I'd add is, there's a lot of different types of structures available, and different developers have different business models. So some will take an option, i.e., agree the purchase of a site but pay later. Some will buy outright, or they might have a land bank they're sitting on. Others will raise all the equity first and then go searching. So there's 101 ways to do it. So yeah, just make sure when you're reviewing and looking at the options, it's all viable in your opinion. So we'll touch more on that later. But looking at the advantages then for property investors. So say you're an investor there, you might have 4 or 5 buy to lets, you might be earning a good deal of money from your business, etc. You're a high net worth, you're a sophisticated individual, as defined by the Financial Services Markets Act, because that's the phrases they use. So high net worth and sophisticated individual. So if you are one of those investors, what are the advantages of going into a loan note project or investing with a developer through a loan note structure? So the first one would be higher levels of return. So this is really what grabs the investor's attention. So most people will know across places like Birmingham, London, you might be looking at a 4 or 5% net return after your costs are taken into account on a yearly basis in terms of the rental yield. If you're looking at a loan note, property bond structure, you can be looking from 8 to 12% per annum paid back to yourself as an interest rate on your original capital. So it can be a very, very lucrative model. What you've got to remember is you're ultimately taking a share of a property development grade profit margin rather than being a landlord or an investor and taking your yield. So yeah, it can be very, very high returning. It's also hands off. So it's very unlikely you're going to be involved in any form of decision making or influence on the project itself. So it's considered a passive model where you're effectively investing your capital with someone who knows what they're doing. They've done it before. They've got a track record. So they're the experts. Let them get on with it effectively. That's the idea. It's loan note structures in general. They can be well catered to investors that are looking for not only higher returns but also quicker returns. So anyone that's looking for a short-term focused investment, anything from 12 months to 5 years, loan notes can be perfect for. As we know, if you're going into traditional residential property, we're always speaking to our investors and say, look, we want to be in this for the medium to long term, so 7 years plus, for example. So loan notes, if you want to get a quicker return, be a bit more aggressive, they can be a great way to do that. So the next one is predictability and having some sort of certainty around the return that you're going to get back. So you will be contractually guaranteed a certain level of return. I use the phrase guaranteed very loosely, but it will be in your contract that you will receive, for example, 8% back over 12 months. That's the legally binding agreement. So there won't be any relying on the market conditions in terms of fluctuations, any maintenance issues to worry about, any extra costs on the tenant side, etc., etc. There's a clear exit. Now, again, it's going to be a consistent theme throughout this. It does vary on the model that the developer's utilizing. So are they refinancing? Are they selling off the units individually to pay back investors? Are they just selling the site in one go once they finish to an institutional fund? There's loads of ways that developers will exit from a project. But from your perspective, you will have an agreed time frame and when you can expect that capital back. So it is quite transparent in that sense. Security. Now, obviously, you're not going to be going and deploying capital to developers without getting some kind of protection and security in return. Yes, you have your legal loan note agreement where that company is obligated to pay you back. However, what you'll also see is additional security provided through what we call a charge, which will be the ability to take ownership over the property or take profits from the sale of the property if the developer was to default on your repayment. In other words, if you're promised 10% in 12 months and the developer doesn't deliver that, and it gets to the stage where the developer's legally forced to sell the property to repay your capital, having a charge in place is what allows that process to take place and to progress effectively. So you can see how this type of investment is not suitable for your everyday Mr. Buy to Let with 50 grand to spend on their first property investment. It's got to be for people that are able to weigh up the pros and cons, look at the risk profile, and then match that to their investment objectives effectively. So moving on, just a couple more on the advantages side. So diversity. Again, going back to what we mentioned earlier, if you've got a few buy-to-lets under your belt, you want to do something a bit different. You're thinking about going into the refurb side or into the development side, or you might be looking at doing a joint venture with a partner of yours. So having a bit of diversity in your portfolio is really advantageous. And the way you can achieve some of that diversity is through partnering with a established developer, again, experienced, knows what they're doing, they're experts at their game. By doing that, you can move away from the traditional single let or buy to let model and really start to benefit from those higher developer grade margins. And just lastly, the entry level can be quite low. So you'll get loan notes where you can individually invest as low as 5K. And there's ultimately there's no upper limit. Anyone's going to be willing to accept the additional levels of capital as well. But you can get started with as little as 5K. So hopefully I reeled off those advantages relatively quickly. There is lots there. So for the right type of investor, it's an absolutely ideal investment structure, but it comes with a caveat. You really have to be able to assess and make an informed decision on the person you're partnering with and the structure that's in place there. So that's a few advantages. We'll move on to maybe some of the cons or the disadvantages now. And I think, Toby, if you run through those, that'd be great.
Yeah, definitely. Because there's always some cons. It's not all positive, but yeah, the first sort of disadvantage of a loan note or consideration of a loan note, let's say, is, and I think you did touch on this earlier, Nick, is you don't have control. So there's no control in the project that you're actually investing your money in. So you are kind of giving your money across and you're leaving it in their hands completely. So there's very, very rarely going to be a time when you'll have any involvement in the decision-making process at all. So that would be the majority of the scenarios. You're effectively just a lender, like the bank. When the bank loans you money for you to buy a house, they don't come around and start telling you how to paint the walls or what furniture to put in. It's literally the same thing. You're there silently and just investing the money in that way. You have to be able to and be capable to do a strong level of due diligence, as there is a lot needed when you're considering a loan note, because you need to look at the company, who they are that you're going to be loaning this money to. You have to look at them. If they're obviously a developer, what's their track record? What have they done before? Have they done any projects previously? Have they done projects where they've raised money via the loan note route and they've paid all their investors back on time and all the correct funds? So there's a lot you have to look into, and it's very important you do so because, of course, your capital is at risk. And when you're entering that sort of agreement, you have to make sure you're fully confident and you know exactly what you're getting yourself in for, because as we mentioned, your funds are entirely in their hands. And just touched on it there, but your capital will still be at risk. So it doesn't matter how good the investment is, how secure the investment is, that your capital can be lost at any point. Yes, you will have security over hopefully the land or some sort of form of security in some shape or form, but again, that doesn't mean it's 100% guaranteed that you're going to get your money back. I mean, if you just look at the current conditions we found ourselves in with COVID, that caused delays. There's been construction issues, labor issues, material issues, etc. So that's, again, something you always have to consider, that whatever you're investing, you have to be aware that it is at risk and you have to be comfortable in doing so. The other thing to consider is it is unregulated. So this is another form of risk. So although there are marketing restrictions on actually marketing loan notes as an investment product, it's not actually an FCA regulated market or investment product. So you just have to bear that in mind. You can't go to the FCA and say, excuse me, I've just lost my investment. Can you come and investigate this for me? So you have to bear that in mind. But they are obviously not as many things to consider or disadvantages, let's say, in comparison to sort of the advantages. But what I will say is the magnitude of those disadvantages or things to consider are quite large, hence why it's something very serious to think about before going into an investment like this. But look, there are plenty of asset-backed loan notes or property bonds out there that have paid investors back on time, do very well, projects go through absolutely fine, and people walk away happy. We're not saying that's not the case, not trying to scare you completely, but it's just something that we stress you really have to highly consider when considering going into an investment of this sort.
Yeah, I think you hit the nail on the head when you said there's not a whole long list of disadvantages, but the key factor is the risk profile and the risk appetite for the investor. There is a reason why they are paying you back 8 to 12% per annum. It's because it's a higher risk. It's ultimately a construction project that you're entering into. So as long as you're aware of that and you're comfortable with that and it suits your investment style, then yeah, that's great. But do not underestimate the potential risks that we're discussing here. So, I mean, kind of tied in with that, what sort of things do we want to think about, or what do we want to consider when we're looking at a loan note opportunity or an investment product? So the first thing, and fundamentally the biggest one for me, is the security. So if the developer folds or if they decide to run off to Dubai or something, what security are you going to have there to get your capital back? So this security comes in a couple of different forms, but it's effectively from the asset. I mean, we can go into greater detail here. You can get sort of personal guarantees and things like that, but fundamentally, what you'll see most of the time is where there's a property, either a land, a half-built project, or property portfolio, which is used as security that can be sold if the developer defaults on repaying investors. So you'll see various phrases banded around. So things like first charge, floating charge, second charge. Again, we won't go into these now, but they're different levels of security. But fundamentally, they all relate to a property or a portfolio being used to repay investors if the developer ever defaults. So number one thing to look for, security. Secondly, the borrower. So this is when you look at the developer's profile, which Toby mentioned earlier, their track record of repayments, as well as construction builds, their general background and industry experience, etc., etc. We want to make sure that they've done this before, they know what they're doing, they've done it on time before, and they've done it on budget before. So it's really, really important to only partner with people that effectively know what they're doing, they have the expertise to deliver.
just quickly on that point, I think, it's great to see sort of them deliver on time, but sometimes it's also good to see if there has been a problem in construction or development, how have they solved it, and how did they sort of get past that? Because in construction, in building, there's quite a high chance that there could be a problem or delay or something happens. Nothing ever goes 100% smoothly, and if that has been the case, it's also good to see that they did rectify it. People still got their money back. Maybe there was a slight delay, but they got what was promised. So I think that's also something you don't want to just disregard completely somebody who maybe had come into a bit of trouble if they then rectified it and sorted it, because as I said, that does happen in construction and building. Think problems can arise, but as long as they're dealt with and solved and dealt with accordingly, then again, that can help give you a bit of confidence in that sort of developer or project as well.
Yeah, absolutely. That's a brilliant point. I mean, fundamentally, what you're looking for, if there are issues, there are delays, is integrity and communication. So, have they stuck to their word? Have they said, "Oh, we're not going to pay you back now, but we will do in the future"? And have they been clear with their communication throughout the process, keeping you updated? What are they doing to rectify the situation, etc., etc. But yeah, that's definitely a great point to consider. And then just flying back round to looking at the developer again. And the only other thing I wanted to mention is the local market experience, because you can develop a project in one market, you can base it on the values, the resale potential, the demand on the back end, the ability to finance the site or refinance the site, etc., etc. But then you can go to another city and you have to do it, all again, etc., etc. Now, medium to large house builders, that's not going to be an issue, but for those really really small scale operations, that may be something we want to take into account. Now, as well as the developer, obviously we want to look at the specific project. So we want to make sure they're not over promising either on returns or the time frame in which it can be delivered. And again, flying back round, have they been in this location before? What's the exit like? Who's backing up? Is there refinance in place, and who's providing that? Is that all confirmed and 100% done and dusted, etc., etc. So we want to look at the individual merits of the project, including the back end profit, the gross development value, and the overall financials, to make sure it's a viable proposition that we're safe to deploy our capital to. And then just finally, in terms of things that you need to consider before investing in a loan note, is your general risk appetite. So it goes back to the age old saying, only invest what you can afford to lose. So are you comfortable with the amount you're investing? Don't overstretch yourself just to get a percentage extra return. Make sure you understand you're going into what's ultimately a high risk investment product, and that your capital you've ring fence, you put that aside, and you said, right, based on this, based on the market now, based on this project, based on the security, based on the developer, I'm happy to deploy this capital. Let's go for it. But what you don't want to do is deploy too much and then worry about it for the next 12 or 18 months or however long the loan note is. So I think that's definitely worth considering as well, just your general appetite to investing. Anything else to add there, Toby?
No, I think that's covered it all very well, and yeah, you've hammered home exactly what you need to be looking for when considering a loan note and what loan note or who to go into a loan note with. So that's great. I mean, just on a final side, looking at loan notes, they're really suitable for a sophisticated investor that wants some form of diversification. They might have a buy-to-let portfolio, stocks and shares, etc. So, a good bit of experience there, looking to diversify, or they're looking to get more into the property development side, but again, they're not going to be there on construction sites or getting into that part of the business, and just want to put the money up and still follow the progress of the development and be involved on that side of things. And also an investor that understands that it carries a higher risk. So when you are getting into one of these, that you do understand the risk involved, but of course that does also come with a higher reward, and that's what we do see with this type of investment. So although it does sound scary, if you can partner with the right developer on the right project, etc., who can act with integrity and make the sort of the process as stress-free as possible to some extent, then they can be very lucrative investments and a great way, as we said, to diversify your portfolio and be involved in property and property development without as much as the headache as well.
Good stuff. I mean, just to finish off then, the only other thing I'd add very quickly is, as a company, Track Capital now doesn't directly introduce investors to loan notes. And the reason being, as we touched on the beginning, there's a lot of marketing restrictions around it. The FCA look at how they're structured and marketed. There's restrictions from Google, etc., etc. So it just doesn't suit our business model. However, we can make relevant introductions if you wish to, and we're happy, as we say with all our investors, to provide a second opinion. So if you've spotted one that you like, or if you want just an extra bit of insight on an opportunity you may be considering, feel free to get in touch with us. Either visit trackcapital.co.uk and submit an inquiry, or email info@trackcapital.co.uk, and either myself or Toby will get back to you and hopefully add a bit of value and just give some general impartial insight.
Oh, yeah, 100%. We're always here to help and always happy to do so. So that's all we have for you this week. Thanks for joining us again, and we will see you next time. Bye-bye.
Thanks, everyone. Bye.